Chapter 4. Reconciliations. So one of our internal control measures is reconciliations. Now we basically get 3 reconciliations in business that we will briefly discuss. The first is bank reconciliation that we will discuss in full now. Then also you get creditors reconciliation that we will discuss a little bit later in this chapter. And then you get debtors reconciliation, which we will only touch on. So bank reconciliation is where I compare what I have recorded in my bank in terms of cash receipts, cash payments, and what my records say of bank versus that the bank keeps for me as well. So in terms of ABSA or Nedbank or Standard Bank, so their records compared to my records, and we see whether the two are reconciled at the end of the month. So first we need to understand bank reconciliation in terms of our bank account versus the bank statement. In other words, our bank account versus that of the actual bank. So the cash receipts and cash payments journals are posted to the bank account in the general ledger every month in order to determine the balance of how much money the business should have in their account. Remember that the money in the bank account is an asset to the business, and that the bank account increases on the debit side when money is received, and it decreases on the credit side when payments are made. So if you look at the T account of our bank account would increase on the debit side, decrease on the credit side. Increases when we receive money or direct deposits are made, decreases when check payments are made or if direct deposits to someone else is made. So the bank also keeps track of all business transactions regarding the business in order to determine how much money the business have available according to their records. So their records means ABSA's records or Nedbank records or Standard Bank's records. So the record the bank keeps on behalf of me, of my account. So at the end of every month, the business receives a bank statement from the bank. The bank statement is the account of the business in the bank's records and is done in the form of a creditor's ledger accounts. It reflects all transactions concerning the business and of which the bank is aware of. It is important to realize that the bank regards the business as a creditor in the if the business has money in the bank. Think about this. A creditor is someone that we owe money to. So if I put my money in the bank, then basically the bank owes me my money. So therefore they owe me money, therefore I am a creditor to them. So all deposits made by the business will mean the bank owes more money to the business and will be credited in the bank statement. And every time the business withdraws money, it will mean that the bank owes less money to the business and therefore the amount will be debited on the bank statement. So it's directly reversed of what happens in our books. So in other words, the bank statement has a debit when checks or deductions or bank charges are made, and a credit which increases when all deposits are made. So please watch out. Our bank increases on the debit side, but the bank's bank increases on the credit side. Our bank decreases on the credit side, but the bank's bank decreases on the debit side. So opposite of what happens in our books is that of the bank. Now, 2 very important things is this. The balance, if it's a credit balance in the bank statement, it means it's favorable. And a debit balance would mean it's unfavorable. If the business has a favorable, positive balance according to the bank statement, it means that the business has money in the bank and that the bank owes money to the business, and therefore the bank statement has a credit balance. If, on the other hand, the business has an unfavorable or negative balance according to bank statement, it means that the business has withdrawn more money than there was available in the account, and subsequently owes money to the bank, and therefore the bank statement will show a debit balance. So every month the business will have engaged in transactions that has already been recorded in the cash journals, but of which the bank is still unaware. For example, checks issued but not yet being presented to the bank for payment, or deposits made but not yet added by the bank on the bank statement. There can also be transactions regarding the business that have already been recorded on the bank statement but has not yet been entered into the cash journals. For example, direct deposits made into the business's bank account, bank charges imposed by the bank, or interest earned or charged. So in short, at the end of the month, the balance of the bank statement and that of our bank account will differ because of transactions that have not yet been recorded in both the records of the business and the records of the bank, or because of errors made by any one of the two parties. And that's exactly the reason why we need to reconcile. Reconciliation means that we check whether we can get our balance to the balance of the bank. So if we exclude any differences caused by either our account or their account, if we can balance out or reconcile the two totals in terms of my bank account and that of the bank. If we can do that, then internal control has been done and checked, and we can account for all information regarding our bank.